that there are huge shortages everywhere. Whether it's COMEX or London is immaterial. And incidentally, also the shortages seem to be in Shanghai, because the silver stocks have gone down. I mean, they're under 600 tons now, which is seen rather as a Rubicon figure. It's perfectly capable of taking silver. Well, I mean, we're approaching 60 as we are. I mean, spot is 58.3. 60 is a doddle this week, easily. I mean, that's not a forecast, but I wouldn't be surprised. 70, 80, 90, 100. I mean, this is equally possible. The other thing, of course, I'm going over to gold, which we need to move on to, is that what gold is telling us is that the whole fiat currency system is getting into deep trouble.
In today's interview, respected analyst Alasdair Macleod breaks down the rapidly tightening conditions across global precious metal markets, revealing why silver shortages are becoming impossible to ignore. According to the latest data, inventories are falling sharply across major hubs. COMEX and London are facing visible strain, but even Shanghai, historically well supplied, is now dropping below the critical 600-ton threshold. This steep contraction in available metal signals a structural imbalance between physical demand and deliverable supply. Meanwhile, silver's price action continues to accelerate. With spot already pushing into the upper $50 range, the metal appears poised to test $60 with ease. Macleod notes that this isn't a forecast. Rather, it's a reflection of how thin the market has become. Under current conditions, a move towards $70, $80, $90, or even $100 cannot be ruled out, especially if physical shortages deepen and exchange inventories continue trending lower. At the same time, gold's behavior is signaling a broader shift, increasing stress across the global fiat currency system. As confidence erodes, capital is flowing toward real assets, amplifying the momentum behind both gold and silver. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
But the fact of the matter is that in everyone's common law, gold is money, and it is a stable form of money, and has been and will continue to be through millennia. So when we see the gold price rise from, in 1971, from $35 to currently $4,234 as we speak, I mean, that's not gold rising, that's the dollar declining. The idea that you can measure the dollar's decline by looking at consumer price index and all the rest of it, well, that gets fiddled. As we know, the best indicator that you can possibly have, not perfect, is what is the exchange rate between dollars and gold? Now, the interesting thing, Danny, is that when you look at expectations, if you like, amongst economists and also portfolio managers, they think that inflation is becoming less of a problem in 2026. They think the purchasing power of the dollar, it might drift back towards the 2% target, but basically they don't see it going up. What gold is telling us is no. That's wrong. The purchasing power of the dollar is going to decline, which put another way means the consumer price index is going to start rising, and probably quite sharply. And we can see that. Now, the reason that the consumer price index will start rising is because the purchasing power of the dollar will be declining. We are losing confidence in credit. Now, I know many economists, most economists perhaps, think that currency isn't credit, but oh yes, it is. It appears on the central bank's balance sheet as a liability. It is credit. It is the liability of the central bank. And we know that most of these central banks, including the Fed, by the way, have obligations greater than the assets to back them in terms of value. I think that's all you need to know. This is a squeeze on the system. China has gone out of the market completely. I mean, you can't arbitrage silver from China to sort out our markets. And that is if they were prepared to do it anyway. The squeeze is also in China. I think it's a global squeeze, and it's the result of over 5, 6, maybe 6 years of supply shortage relative to demand. And demand is just, going off the scale with photovoltaic cells and all the rest of it. So silver it's being driven, if you like, by industrial means. There will come a point when the investment community wakes up and decides we better have some silver. I'm not going to speculate as to what their thinking might be, but at the end of the day, you can't resist a bull market in anything. When you see something going up, if you are beginning to get, the price of, let's take an index of silver stocks. If they really started to move ahead of the game, then quite clearly it would be the investment community saying silver is in a bull market. We got to buy these mines. Yeah, they're not doing that. Honestly, they're not bullish. You and I and others, if you like, who've been following gold and silver for some considerable time, could express our views by saying we're bullish of gold, we're bullish of silver. And I've just explained why the market is short, et cetera, and that's going to drive the price higher. But the investment community as a whole is just not interested. They don't understand it. They would rather chase the Nvidias and the tech stocks of this world. I mean, when we start talking mines, average investor he's clueless. He's got no idea. And he doesn't want to know, really. I mean, it's just too difficult. Just give me the things I understand, he says, I think. I think that's why you've got this sort of extraordinary situation where the response from silver mines and, encapsulated in the indices, and also for gold as well, and other mines in general, is just a complete disinterest from portfolio managers. Yeah, I mean, they've had commodities educated out of them. And apart from anything else, a commodity is not a regulated investment, and therefore it's verboten. Don't go there, mate, sort of thing. I think we're probably beginning to do that anyway. When we see the stands for deliveries, I mean, I haven't actually ahead of this looked at my numbers, but I think we're looking at about 12,500 tons of silver this year, 12,500 tons of silver this year, and roughly 1,200 tons of gold. I mean, these are huge numbers. The COMEX has turned out to be the largest precious metals mine in the world by, 3-4 times the largest mining nation.
In today's critical market breakdown, veteran economist Alasdair Macleod outlines why silver is entering one of the most explosive phases in modern financial history. With physical shortages accelerating across COMEX, London, and even Shanghai, where silver stocks have slipped under the key 600-ton threshold, global supply pressure is reaching a breaking point. Macleod explains that spot prices pushing towards $60 are only the beginning, and jumps to $70, $80, $90, and even $100 are no longer unrealistic. These levels are being driven not by speculation, but by a structural shortage built over 5 to 6 years as industrial demand surges, especially from photovoltaic and high-tech sectors. The situation is intensified by deepening cracks in the fiat currency system. Gold's rise from $35 in 1971 to over $4,200 today signals not a stronger metal but a declining dollar, with purchasing power eroding faster than mainstream forecasts acknowledge. As confidence weakens, inflation is poised to rise sharply again. With currency functioning as central bank credit, the global monetary structure is under growing strain. China's withdrawal from the export market removes the last possible relief valve for Western shortages, confirming that silver's tightness is now worldwide. And while seasoned metal analysts recognize the magnitude of this moment, the broader investment community remains disengaged, still chasing technology. Stocks, while ignoring one of the most significant supply-demand squeezes in decades, massive COMEX delivery volumes, over 12,500 tons of silver and 200 tons of gold this year, underscore how unprecedented this shift truly is. Let's get into the interview.
There was, actually, as it turned out, we're talking about 36 million plus ounces of silver in a stand for delivery on COMEX. And coincidentally, the whole of the COMEX system had a data fault. Now, did they pull the plug because they couldn't resolve the situation? I mean, we're talking about a delivery of $2 billion worth of silver. This is large. There was also a very large delivery of gold, over 58 tons on that same day. So, I think the markets are showing huge, great strain. Now, the fact that the rumor started in Shanghai rather suggests that the stand for delivery was of Chinese origin, or at least origin in that part of the world, and was known in that part of the world. I mean, I could certainly see, someone standing for delivery like that would be quite happy to talk to his chums, if you like, and say, guess what? I'm standing for delivery for $2 billion worth of silver. And I reckon that's going to tip the market up, or whatever I say, but you can see how the rumor might start there.
Yeah.
And confirm, if you like, that it's Chinese sources who actually went for it. But the other thing that's fascinating is, was it just coincident that a data center had to shut down because it was overheating? No, I read somewhere by someone who is supposedly an engineering expert on cooling systems that Data centers like that not only have one complete backup system, which automatically switches in if the principal one fails, but usually they have a backup to the backup. So this failure system is a bit fishy. So could it be that the powers that be just pulled the plug on the whole system while they tried to sort it out?
The latest developments inside the precious metals markets reveal a level of stress that can no longer be ignored. The sudden 36 million ounce silver stand for delivery on COMEX, combined with nearly 2 billion in physical demand, has exposed just how thin the system truly is. At the same time, over 58 tons of gold were requested for delivery that very same day, a remarkable signal that major players around the world are moving aggressively into physical metal. What makes this even more concerning is the reported data outage that froze COMEX operations exactly as these massive delivery demands hit. Engineering experts have already pointed out that systems of this scale always maintain multiple backup cooling systems. A failure of all layers simultaneously raises the possibility that the shutdown was intentional. With rumors originating in Shanghai, the evidence points strongly toward Asian buyers standing for delivery, a move that places additional stress on Western inventories already strained by years of declining stocks. The global squeeze on silver is no longer hypothetical. It's structural, prolonged, and accelerating. If these pressures continue, analysts warn the market could reach a point where price adjustments happen rapidly and without warning. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on it. Appreciate you for tuning in.